On Wall Street Part 5, the real test of numbers. In Part 4 we saw that the perfect stock is often hidden not behind something flashy, but behind a boring name and a simple business. Peter Lynch explained that stories about hot stocks, fancy names and the next big company excite investors quickly, but that very excitement often turns out to be the most expensive trap. However, Part 4 left one question incomplete. If we find a perfect-looking company, how do we know whether its story is true or just the market's shine? Imagine an investor sitting under a table lamp at night. The annual report is open in front of him, the stock price is flashing on his phone, and just one thought is revolving in his mind. Will this company truly create future wealth, or am I just buying a beautiful story? This is where Part 5 begins. Because in the real court of investment for Peter Lynch, it is not emotions but earnings and facts that give testimony. Stories run fast in the market. Someone says the company is expanding, someone says the product is a hit, someone says the management is visionary. But Lynch asks, where are the earnings? How will the money come in? And is the plan being described actually showing up in the numbers? Because in the long term, a stock price does not rest on air. It rests solely on earnings, assets, and business quality. A company's value increases because people believe that in the future it will earn more, build more assets, or make its business more profitable. If this reason is not clear, buying a stock is like following a sound in a dark room. Peter Lynch says that the future cannot be predicted, but a company's plan can be understood. Will the company raise prices? Cut costs? Open new stores? Sell more to old customers? Fix a loss-making unit? When the plan is understood, the investor's next job is not prediction but tracking. Watching whether the company is truly moving toward its promise or not. This is where the real test of earnings begins. Earnings are not just a number, they are the company's heartbeat. If the heartbeat is strong, steady and moving along with growth, the story has life. If the heartbeat is weak, outside shine will be of no use. Now comes the PE ratio, which many people consider complicated. But its basic meaning is simple. How much price an investor is paying for every single rupee of earnings. If the stock price ran up very fast and earnings lagged behind, the PE can become high. This means the market is placing very high expectations on the future. However, a high PE is not always wrong. If the company is truly growing fast, the market is sometimes ready to pay a higher price. A low PE is also not always a bargain. Sometimes a stock looks cheap because the business is falling and future earnings are going to be weak. In other words, the PE ratio is a signal, not a final judgment. It asks a question, it does not give an answer. For Lynch, a smart investor is one who reads the PE alongside the company's category and growth story. A high PE in a slow grower can be a danger signal because if growth is slow, justifying an expensive price will be difficult. In a stalwart company, the PE becomes very important. If a strong company is available at a reasonable PE, an investor can see a measured and steady opportunity. In a fast grower, the PE has to be compared with the growth rate. If growth is strong, the market is large, and execution is clear, some premium can make sense. In a cyclical, the PE can be the most deceptive. At the time of peak earnings, the PE looks low, but that can also be the top of the cycle. In a turnaround, the PE sometimes becomes useless because earnings may be depressed or negative. There, survival, cash and debt become more important. In an asset play more than earnings, one has to look at the real worth of the asset and the unlock possibility. Land, cash, a subsidiary or hidden value can change the story. This is the first big insight of Part 5. The same number carries a different meaning in a different category. Now imagine an investor chose a slow grower. What will its test be? Here the question is not about a 10-time return, but about dividends and stability. If the slow grower gives regular dividends, does not stop payment even during a recession, and earnings are not collapsing at all, then it might be fine in its role. But if the slow grower is giving neither growth nor dividends, the investor should ask, with what hope am I sitting here? The story of a stalwart is different. It is not a small rocket, but a company like a big reliable ship. In this, the buying price is critical. If you bought at a very expensive valuation, even a good company can give mediocre returns. In a fast grower, excitement is natural. But Lynch asks, where will the growth come from? New stores? New cities? New products? Or just the story of past success? If a company says it will open 100 new outlets, the investor should look at whether the old outlets are profitable or not. Expansion is powerful only when unit economics are strong. Otherwise, every new store can become a new burden instead of growth. In a cyclical company, sales trends, inventory, and the industry cycle are very important. Here, wrong timing can cost an investor dearly. If demand is up, prices are high, and everyone is optimistic, perhaps the market has already priced in the good news. In a turnaround, the investor should look at oxygen first. How much cash does the company have? How much is the debt? And how much time will lenders give? Many turnaround stories look beautiful, but if the company does not even have the time to survive, recovery remains just a word. In an asset play, the biggest question is, why is the asset hidden and how will the value be unlocked? If a company has valuable land, but management is not going to sell or use it, the asset can become mere comfort on paper. Now comes the 2-minute drill. Peter Lynch wanted an investor to be able to explain their stock story in 2 minutes. If you cannot explain in 2 minutes what the company does, why it will grow, what the risks are, and why the valuation is fine, then perhaps you have not understood the company. This drill seems simple, but it is the toughest test. Unclear thinking hides behind long explanations. An investor says, "This stock is good because the future is bright." For Lynch, this answer is weak. A strong answer would be, the company is a leader in this product, sales are growing, debt is low, expansion is profitable, and the stock is at a reasonable valuation compared to the industry. The 2-minute story brings you from excitement into discipline. It asks, do you have a thesis or just a tip? In today's social media market, this drill is even more necessary. Because many people buy a stock after watching a 20-second reel, but cannot explain the business in 2 minutes. If the story started from a stranger's voice note and did not end on facts, the risk is yours, not their confidence. Now let's move on to the ground of facts. Lynch says an investor is not helpless when it comes to getting information about a company. You can read the annual report, check company filings, listen to investor presentations, visit stores, use the product, and talk to customers. If in doubt, you can even ask questions to the company's investor relations. Many companies answer basic queries because a public company ultimately has to put facts forward. A ground check can be very powerful. If a company sells a retail product, the store shelf often gives signals before the spreadsheet. Is the product available or not? Are customers repeating or not? Is the competitor more aggressive or not? Has the discount become permanent or is it temporary? However, ground checks also need balance. A crowd in one store does not mean demand across the entire country. Popularity in one city does not guarantee national success. That is why Lynch looks at observation and numbers together. The eyes give clues, numbers give confirmation. Now comes the turn of famous numbers. Percent of sales is the most underrated number. If a product is very famous, but accounts for a small share of the company's total sales, the impact of that product will remain limited. This was the warning in Part 4. A good product becomes a good stock only when it meaningfully affects the company's earnings. Cash position is another important clue. Strong cash gives a company breathing room in difficult times. A cash-rich company can endure longer during a recession, temporary losses, or an expansion phase. But cash is also useful only when management uses it wisely. The debt factor is even more serious. Debt can speed up growth, but at the wrong time that same debt grabs the company by the throat. If debt is much higher than equity, interest burden is heavy, and cash flow is weak, even a small trouble can become a big crisis. Lynch's simple wisdom is that a company with no debt stays far away from bankruptcy. Dividends can also be a signal, especially in slow growers and mature companies. A regular dividend shows that the company is returning cash to shareholders. However, dividends should not be followed blindly. If a company is paying dividends by taking debt or maintaining payouts while the business is weakening, danger is hidden there. Inventory is also a hidden warning. If inventory is growing faster than sales, products might not be selling. In retail or manufacturing businesses, this is very important. Warehouses are filling up, shelves are slowing down, and profit currently looks beautiful in reports. However, a few months later, discounting, margin pressure, and write-offs can flip the story. Profit margin also tells the quality of a business. A high-margin company has a buffer. In a low-margin business, even a small mistake can eat up profits. Margins should be read according to the industry though. Judging grocery, airlines, software, and luxury products on the same scale would be wrong. Book value can be useful in asset plays, but not every asset truly shows market value on the balance sheet. Sometimes land is undervalued, sometimes inventory is overvalued, and sometimes goodwill is like air. Therefore, understanding the quality of the asset is necessary. Now comes rechecking the story. An investment decision is not a one-time event. It is an ongoing investigation. After buying a company, the investor should keep asking, is the original reason still valid? If a fast grower's growth slows down, the thesis has changed. If a cyclical comes down from the cycle top, expectations should change. If a turnaround plan is failing, debt is increasing, and management is making excuses, do not make hope a strategy. If the asset is never unlocking at all, hidden value can permanently lock your patience. Rechecking does not mean looking at the price daily. It means matching the business story and facts from time to time. The market price changes every day, but the real direction of the business unfolds over quarters and years. Here, an investor needs both patience and alertness. Patience alone is not enough, because in a bad business, patience can increase losses. And alertness alone is not enough either, because panicking at every small drop can destroy long-term gains. This is the major turning point of Part 5. Research does not mean just homework done before buying a stock, but an ongoing responsibility during ownership. When you buy a stock, you do not become an owner of a price, but a small owner of a business. An owner needs to know the condition of their business. If you were a partner in a restaurant, would you never ask about sales, cost, rent, and customers? Then why do you look only at the price after putting money into a stock? Lynch's framework gives this very ownership mindset to the investor. Tell the company's story, identify the category, check the numbers, gather facts, and then recheck the story. Now the final checklist comes up. Consider a small company, but not just because it is small. It is good if debt is low, but the business should also be good. A buyback can be positive, but understanding the price and intention is necessary. Be careful of popular crowd stocks, but do not make an unpopular stock a hero without a reason either. Look at dividends, look at cash, look at inventory, look at sales contribution, compare PE, and most importantly, clearly see how the company will earn more going forward. If a stock does not pass your 2-minute drill, perhaps it should not get entry into your portfolio. This is the satisfying payoff of Part 5. In investing, numbers do not kill creativity, rather they bring the story closer to reality. The story excites the investor, but numbers keep them grounded. Only a grounded investor can survive the noise of the market. Now we have almost the complete toolkit. We understood edge, understood emotions, understood categories, saw signals of a perfect stock, and now we have also seen the test of numbers. However, the story is still not complete, because buying a stock is difficult, but holding a stock until the right time and leaving it at the right time can be even harder. In Part 6, this final test will open. When to buy, when to sell, what to do during a fall, and why patience in the market sometimes becomes the most powerful weapon. Because the scariest moment is not when a stock falls. The scariest moment is when an investor does not understand whether the fall is an opportunity, a warning, or the end of their thesis.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.